All right. Good morning, ladies and gentlemen. I hope my audio is pretty clear for everybody in the room. Is that all right? Okay, perfect. I'm delighted to have Ms. Rajiv Anand and Ms. Shanti Kambaram on this panel. Thank you so much for coming through and then having us, helping us discuss the theme of this event, which is accelerating the banking potential. Before we start on some of the more specific questions, I wanted to ask each of you, what is, to your mind, the potential that we're talking about? What has it been achieved? What can it achieve in the future? What are we talking about when we're talking about the Indian banking system? First, Mr. Kambaram, then Ms. Anand.
Hi, thank you. And thank you for inviting me here. I think if I were to talk about the potential, I'd say the potential is India. 130 to 140 crore people, 60% of them less than 30 years. You still haven't seen them fully coming into the banking sector, right? And they are aspirational. They will consume. They want to do things differently, right? Second, there are many Indias. You have the metro India, who's been there, done that, and think differently. The urban India, the rural India, the semi-urban India. I think if you go across India, tier 2, tier 3 cities, there's so much hope, there's so much entrepreneurship, there is so much, aspiration. So if I were to say, the opportunity is India. If you see the last 2 years, our economic growth perhaps stands out in the world. This is supposed to be India's decade, from 1 trillion to 5 trillion GDP. If that happens, I can say banking will be at the center of it, because as your colleague said, it is very closely linked to the economy. And I think whether it's individuals or non-individuals, the opportunity is immense. It's really, where do you want to do, what do you want to do, and how do you want to leverage this opportunity?
All right. Mr. Anand.
Can't agree more, Shanti. I think, we will get to 5 trillion. It's just a question of time. And we will get to, 10 trillion. And what that will mean is that affluence will continue to percolate downwards. People will use more digital. People will move from the informal sector to the formal sector, which means that the ability to bank these people only will improve. We've done tremendous work on payments. Shanti mentioned that. But it might surprise many of you that even today, only 2%, 2 to 3% of our population has credit cards. The equivalent number in China would be 40-45%. In Brazil would be something like 25 to 30%. Now, one could argue that the form factor of that plastic credit card could be different, but fundamentally, the ability of us being able to provide credit for transactions, credit for relatively lower value transactions, etc., is tremendous. And I think that is only going to continue to grow. I am very, very excited about the MSME sector. And I do believe that the next decade is what retail was in the previous decade. You saw in the previous decade the building out of infrastructure which helped retail lending, which means that you got Aadhaar, which made it simple to identify you. You got mobile, which means that it was easy for me to deliver these financial products to you at a click of a button. You got credit bureaus, so therefore the understanding of the fact that you have a credit assessment which is available publicly, and therefore if you screw up on that, you will not get a loan again. Ensured that credit discipline came about. And finally, data. And banks that were able to convert data into insights and deliver that to customers, through mobile, for example, have been able to build strong portfolios on the retail side. And it's very interesting to see, every year for the last 10 years, we've been talking about the retail credit cycle, right? And we've had some conversations, when is it going to get worse? But this has been a cycle that's played out for 10 years, except for that brief period in COVID. And even after 10 years, if you look at the China cycle versus us, we're still 10 years behind them. And so therefore, the runway for growth for us on retail assets will continue to be very strong. And today, most of the lending that we do is really AAA, which means that 725, 730 credit scores and beyond, it will percolate lower. It may not necessarily be with banks, but there will be other entities who will come in as well. SMEs will continue to grow very strongly because of the fact that earlier we were in a sense data dark about many of these entities. Now we're seeing so much more data because of formalization. And I think that is going to drive the MSME sector as we go forward. People will move from the money lender to banks. And finally, rural and semi-urban. Huge opportunities there.
Yeah.
And so therefore, I do believe that the next 10, 15, 20 years, it's a great time to be a banker in India.
Fair enough. Let me break this up into all the beats that you've mentioned. Ma'am, you mentioned the potential in terms of the population. There's a huge unbanked population, which will eventually, and that's something Rajiv also mentioned, that this will eventually get banked, and that opens up doors for fresh growth. But even today, even with the bankable sort of population that we have, it's not like all of them are great for banks, right? I mean, you're obviously selective in the kind of people that you want to lend to. I want to know what is the true ratio or any kind of idea of how many people actually will be good enough for a bank to chase, because I don't know if it is limited or is it like as big as the population of the country.
I think one point that Rajiv mentioned, which I want to use as here. See, traditionally when bank lent, they did not have access to different kinds of data about a person. Let's talk about retail individual or even business customers.
Yeah.
They used to rely on a score which was put out. But today, if you look at the amount of data that's available, whether it's a social data, whether it's transactional data, behavioral data, in addition to credit data, right? The science that you can apply to this data and thus the ability to lend has gone up many-fold. And we will have to do experiments, right, on different cohorts. The beauty is today you can do experiments on different cohorts and pull back if you see the trends being different. Second, if the economy grows, there will be a trickle-down effect on people's per capita income and the credit quality. If you see today, people who come into the banking segment, thanks to all the digital platforms, almost 40% of them are NTC, new to credit. Now, 5 years ago, you would not know how to lend to new to credit. But today, you can apply a certain data science and new to credit. They will build their credit scores over a period of time. And younger population will want credit. If you look at the debt to a household debt to GDP ratio of India, despite a growth in the last decade in retail credit, it's next to nothing. It's very small as compared to the other countries. So there are two things. There is ability for people to consume more debt. More people are coming into the workforce because of being younger. They are new to credit. They will build their credit profile. So I think opportunities are immense. Data is changing that. Deliverability through digital platform is changing that. And the trickle-down effect of the economy. Now, if you look at these small businesses, sole proprietors, I'm not even getting into the large. Entrepreneurship is there everywhere, right? Some will win, some won't win. But as you get into the middle stage, you're finding a lot of opportunities. And they're all growing. They're investing, they're growing. So I think it's the landscape has changed. Data and digital has changed the opportunity. And banks will use this to leverage. And India's household to, debt to GDP is still low.
I think if I can just add to that, if you look at the way the government has constructed data, in both China and the US, data is dominated by the private sector. And so therefore you're only able to build on the back of what they are able to do. But in India, we have democratized data. And the next level of that, and in that sense, it is things like Aadhaar, which is now publicly available. I can ping Aadhaar to figure you out and your picture, etc. The next level is really account aggregators, right? you may not be a customer of Axis Bank, but if you have a bank account and you are providing consent to me, I now know you a little better because you give me consent to see what transactions you're doing with another bank.
Right.
That's stage one of the account aggregator. Over a period of time, you will provide consent to your mutual fund account, your insurance account, your utility accounts, right? And therefore, the ability of banks to be able to underwrite a wider spectrum of customers is only going to continue to increase. Right, today, because I know a certain set of customers, I'm able to underwrite them. But this number is only going to continue to widen as we go forward. Then there is the issue of, pricing for risk. Based on this data, Shanti mentioned we will run multiple experiments in terms of pricing. Some we will get right, some will get wrong, but that's the test and learn that all of us will go through. And then there is one next level or the level after that which perhaps the banks will not go after, but there will be other intermediaries who will go after that. Will price differently, will perhaps have to build out a better understanding of how to understand those lower, I would call subprime credits, and those in turn will come into the banking sector, into the formal sector, and then perhaps graduate to the banking sector. Nobody wants to borrow at 24%. Everybody wants to borrow at 8, 9, 10%, right? But that's a journey, and I think that evolution will also play out as we go forward.
Okay. I want to ask you a little bit about what happened over the last decade or so. Private banks such as yourselves, you have whisked away that market share from your public sector peers. They were saddled with some of their own problems. But this growth that has been seen within the private banking sector has been tremendous. I don't know what other word to use. Is this a sustainable sort of growth rate?
Definitely. And the reason I'm saying is the whole pie is growing. See, if the economy was stagnant and there was no job, there is no growth, then you talk about how do you gain market share. But the whole banking pie is growing because of the economic growth. Private sector banks have been at the forefront of making sure that the technology changes are incorporated on the digital platforms, mobile, net, etc., and products and service.
Yeah.
I think the market is large enough for almost everybody. And I think if you look at today, you have private sector banks, public sector banks, fintechs, as Rajiv talked about, who sort of take a certain level of this thing. And you have all kinds of financial services player. Now, all of them are growing because the whole base and pie is growing. Yes, it will be competitive, but the whole business is about customer acquisition, value proposition, service, giving them a great experience on your technology platforms. And those who are able to stitch all of this together will win, but even others will have a lot of opportunity. I think India is under-penetrated in financial services, and that is absolutely a fact. If you see over the next 10 years, I think you will see many corners of India being accessed, and banks will be at the center of it.
Thank you for calling this growth tremendous, but both our institutions are still relatively young, and more importantly, relatively small. I mean, Axis Bank, they have a 5% market share on deposits and a 6% market share on assets. So while, as Shanti said, the pie will grow, we would like to believe that private sector banks still are a relative. I mean, as a consolidated entity, if they're close to 35% or so. But I think each of the entities are still relatively small in the larger scheme of things. So I do believe that private sector banks will continue to gain market share, and in that sense, individual private sector banks still are relatively small in the larger scheme of things. But I think more importantly, as we think of ourselves as a $5 trillion or $10 trillion economy, it is an absolute imperative that we have a healthy public sector system as well. And I think everything that the government has done over the last 5 years, we are beginning to see that play out. It's not just the private sector banks who have benefited, from this, turnaround in the banking system. Each of the public sector entities are also delivering record profits, which I think is all very, very healthy from an Indian economic perspective.
I just want to add one thing, and this is about the public. Look at the way they have reinvented themselves. If you look at the top few banks, they're all at the forefront of technology. They have made sure that they are, incorporating various different practices. They've all capitalized themselves, revitalized their balance sheets, and poised. So I think it's been a great run, and I think the banking sector needs all of these different kind of players for the opportunities that will emerge as we move towards a 5 trillion and a 10 trillion economy.
Okay, this was an engine that was closed for some time, the public sector banking system, right? But now we've got down all the repairs and it's back on the road. Do you feel, but then because of the size, because of the reach, they pose a greater competition to you than some of the other private banks that you're competing with already?
So I'll repeat what Rajiv said. If you look at the market share of most of the private sector banks, they're still small. So the ability to grow and leverage the opportunity is there, and it's tremendous. Okay. Second, today distribution actually is very different. Digital has made the world flat, and you can reach anybody, sitting anywhere through technology. Yeah. So when you look at today, for example, savings accounts being open, you download an app, you open a savings account. In the good old days, you had to go reach and then open. So I think technology is making the reach and the distribution factor a very different strategy, right? It's no longer the only advantage. You have to stitch a whole proposition around it. And banks will find their own balance between physical and digital. So I'm very fond of saying banking was physical 10 years ago. In the last 5-6 years, it went phygital, physical enabled by digital. Now we are moving to digital enabled by physical. So you will need the physical presence because banking is based on trust. But what will be the balance? What will be the ratio? Different banks will have different strategies.
The banking system is getting consolidated. If you look at credit cards, the big 4-5 banks dominate, 70% of that, incremental deposits, incremental assets, and so on and so forth. So I think the consolidation phase has well and truly begun in Indian banking.
Yeah.
And you certainly need to stay relevant in that perspective. Gaining market share, all of us have to fight every day, to get that. Nobody's sitting to giving it away. It's my peer private sector banks who are competition. The public sector banks are competition. We are in a technology super cycle. And so therefore we will see disruptions coming and hitting us from spaces that we did not even know existed. And so therefore we've got to, sort of watch out, for, some of those as well. Fintechs, neobanks, and some of banking could potentially get disaggregated as well. Where goods and where services will get unbundled, and therefore take away the more remunerative profit pools for us. And so therefore, but I must also say that I heard the same song in 2012, 13, 14 that, every bank will die, fintechs will come and have us for lunch. But you still invited two veteran bankers here to inaugurate this. So we must be doing something quite all right. So it's not as if bankers are sitting back and ignoring everything that is happening around us. And I think, there's been a tremendous transformation in banks. Banks, historically, we never used to think about UI, UX and what color the screen should be. But we have design experts as full-time employees for us now. And so therefore, that transformation as bankers has certainly happened. And we will continue to fight tooth and nail to ensure that we continue to stay relevant to consumers.
Okay, I want to ask one last question from my end, and then I'll pass it on to the audience for a couple more questions. But the question that I have is on this liabilities part of the business, right? Because analysts have described it as a deposit war that is sort of coming in between banks. In this scenario where you've got a reasonably high credit growth, but deposit growth is still sort of hobbling, catching up. What can banks do? Banks such as yourselves can do to ensure that you are safe on the liabilities front.
Every bank's key focus, liabilities are a bank's assets. Okay, I'm very fond of saying that. And they have a razor sharp focus on liabilities and low cost and stable, which is the CASA. If you have liabilities, can lend. And that's the stable part of it. So each bank makes sure that its distribution and customer engagement strategy. It is about acquisition, engagement, and growing your customer base. If you look at the mix of money in India as a whole, banking deposits still are one of the largest, right? It is massive and it's across India. Now, if you look at the metro India, they have moved part of the money into investments. If you look at urban India, they are more in banks. If you look at semi-urban and rural, they are largely in banks. As rates go up, so as customers, grow wealth, etc., they will have a portfolio of where they will put. But banking and money in banks, whether it's in the form of CASA or term deposits, will always be central to the Indian household, at least for the next decade that I see. It's up to the banks to decide their strategy on rates, on market, on distribution. But suffice to say, liabilities is the core of a bank. That is the bank's assets. And every bank will have its strategy, but there is a razor sharp focus. I think there's ample in the market. Yeah, there is market share to be gained, and deposits are growing, as you can see. So each bank will do what it takes.
Okay, fair enough.
No, I can't agree more. I think it's just become fashionable today to talk about in this so-called deposit war, liability war. It's been the same forever. I remember my retail days. Every morning we used to wake up to figure out, whether your CASA balances, went down or up. It's been the same forever. And if you want to build a solid bank, I think we spend a disproportionate amount of time on the asset side, but it is a stable, sticky liability franchise which defines a good or a great bank. And so therefore, most banks, I would imagine, are super focused on what they need to do to be able to grow their deposits on a daily basis, not on a quarter or yearly basis, but on a daily basis. And I don't see any reason why that should continue. In fact, in the new LCR regime that we have, it is not just how much of deposits that we get, but from whom we get. And so therefore, retail and small business deposits are much more valuable to us as compared to getting deposits from, let's say, financial institutions. So we are actually shedding some of that and increasing the amount of retail and small business deposits that we get. So therefore, that has brought a new level of complexity. We are also currently grappling with the fact that if you look at household savings have been going up, but leverage is also going up. But within that, the composition is slowly but steadily beginning to change. You are seeing money going into mutual funds. You are seeing money going into pension funds, insurance, etc. And to that extent, the amount of money coming into fixed deposits is beginning to slow. So that's a battle that we will have to certainly grapple. And this thing about money moving from CASA to term deposits is cyclical. It is what I call the cost of laziness. Today, if you do nothing, you get 3.5% versus putting money in a fixed deposit at 7% or 7.5%. But remember that your savings account is not the account that is going to make you rich. It is your transaction account. You pay your EMIs, you pay your credit card bills, you pay your utility bills through that, and it'll never become zero. So over a threshold of whatever is convenient to you, perhaps you will move into fixed deposits. But nobody empties out their cash, their savings account to put into a fixed deposit.
All right. So at the beginning of this conversation, Alex mentioned that there's a QR code and people were requested to respond to that. We have the results of the first question that we have, which is private banks, are you better equipped to capitalize on the potential? You've got what, 70%? I mean,
70%. Wow.
This is just a straw poll, but of course, vast majority of the people here seem to agree that you're best placed to do that. I just want to get your idea on what is it that private banks could do differently? And I'm not saying what you've done in the past.
I think, if you see what's happened post-COVID, technology and customer experience has become a driving force in even banking customers, because during, COVID, they all used apps for buying food, shopping, etc., and they have the same experience with banks. And that's how fintechs drove this result. I think banks have to 3 areas of key focus, apart from deposit and lending we discussed. A great customer experience as far as their digital platforms are concerned. If you look at an individual customer, when was the last time you visited a bank branch?
I have.
Right? You do everything through your mobile. Your mobile is your bank. Like your colleague mentioned, he doesn't carry his wallet. He doesn't need to. Everything's in the phone. You can pay, scan, do whatever. But that experience is very critical. Experience is not just about the click, but about the resiliency. One thing that big tech has taught us is, you must be up 24/7 and there must be no downtime. So the resiliency in the experience is very important. Banks have legacy system. I can talk about private sector banks. They're moving heaven and earth to make sure that they build the experience level, not vendorize it, as well as the resiliency part. The second is customer centricity. If you look at an Amazon or, a Dyson, some of the great global brands, or Apple, they think customer and then work backwards.
Yeah.
Traditionally, banks have been products and then find customer. I think banks are changing, but they have to change at an even faster pace on customer centricity. It's not just about service. It is about what does the customer want. In India, you'll probably get 100 cohorts. I think in the next decade, we will move to N-1 personalization. What will you want? And banks have to do more. It includes on data, on analytics, and customer centricity, and a great journey on that. And the third is, whatever you say, service is a very, very important differentiator in banking, and customers want responsive banks. I think in all of these areas, and talent transformation that Rajiv talked about, banks have started the journey, but they need to accelerate.
I could agree more with Shanti. I mean, I think digital is not an end state; it's a journey. Apple is creating new technologies. It's really for us to be able to create, to use that to be able to create new experiences, and you've got to ensure that you stay relevant as technology changes, customer experiences change, customer expectations change. The second is, I think private sector banks have done a tremendous job, metro, urban, but I think there's a lot that we can do as we go into what we call, Bharat banking. And the third piece is absolutely, I think, most of the services that we provide are, commoditized, but ultimately, how can you delight the customer? And I think I just saw a survey yesterday in one of the newspapers where 60% of customers felt that service that they get from banks is quite poor. And I think banks that are able to differentiate themselves from a customer experience perspective, I think will certainly win as we get into the future.
All right, we'll take one question from the audience because I know Shanti has to leave. One question, gentleman right here. Somebody help with the mic.
We can even take 2. We still have 6 minutes.
Still have 6 minutes. I hope this question's worth it.
Thank you. See, while it's extremely commendable that private sector banks and banks in general have made vast strides in digitalization, one key stakeholder, namely employees, they seem to be leaving private sector banks in particular in droves. Because you're seeing attrition rates from anywhere from 35 to even 51% in private sector banks. And more importantly, in the less than 30 years bracket, which is around 50% of your labor force, you're finding astronomical attrition, which can be anywhere from 50 to 60%. So the question is, why is it that in private sector banks, there is no loyalty factor for the less than 30 years employees, which you're not seeing this in public sector banking? So one, is this a concern that senior management has? Because if you read the annual reports, there's no discussion at all on attrition. And two, if it is not a concern, do you think you can just be part of your cost of doing business? Are these levels acceptable? Thank you.
Yeah, I'll take that first. So if you look at the levels at which this attrition is, it is at the entry levels. Post-COVID, lot has changed in the young. They are restless. They want a better balance in life. They don't want pressure, and they actually take off, which is very different from the generation that I come from. And if you look at private sector banks, at the front line sales, they still have very young people. Okay, there is a change, and for 10,000 rupees, they will switch. Second, I think it is still just graduates. Two things will change. I think technology will change the way frontline sales happen. Second, there is a need, and the banks are doing that, to up-tier these people from a skill perspective. Yeah. So, two things I'm saying. The young are restless, and their whole attitude to work is different. There is pressure on achieving targets. There's no question about that. But it is also a mindset post-COVID. Second, a lot of this, what I call unskilled or semi-skilled, the graduates are semi-skilled, unfortunately, right, will change as the composition of talent and technology changes the way customers interact with primes. I think both these will address attrition as we go back.
I think it is, like you rightly said, a big issue at the entry level below 30 years, etc. One of the things that you mentioned relative to public sector, actually the public sector pay scales are actually the exact opposite, meaning that they pay much higher at the lower end and much lower at the at the higher end. So therefore, in that sense, the attrition there is much lower. Is this a big issue? Absolutely. I think if I remember, at least over the last 1 year, whether it is our board strategy meeting or at our board meetings, there is at least one session on attrition and what we can do about that. It is an industry-wide issue. At 30-35%, perhaps you could feel, relative to call centers or at 100%, and IT, which is at 50-60%, this number is in that sense, relatively lower, but that is, more on a lighter note. But it is a problem. We will have to, sort of address this. It is a societal issue. One of the things that we are trying to do is obviously to ensure that the employee experience, especially when they come on board, and are they being managed and nurtured, particularly in the first 90 days and then the first 180 days, and then in the first 1 year, improving the employee proposition is something that sort of we are certainly working on. And the second is assuming that this number is not going to materially shift over the next many years. How can we throw technology at the problem, to solve for it? But it is a massive issue, and there are various sort of initiatives on to be able to address it.
All right. Would you like another question, or should we wrap this up here? Okay. Yeah. The last table.
Yeah.
So just 1 second. This is the gentleman there.
Hi, wonderful insights from Rajiv ji and Shanti madam. I'm Arun Giri, a journalist, co-founder of TaxSutra, running a digital platform. We have around 75 to 100 employees, and the corporate banking experience in the last 10 years has been incredible. As Shanti madam said, I have not been in a bank for 6 years in any branch. But I have one question, is that there seems to be a bias whenever you are a small organization. There always seems to be a bias in favor of a larger company when extending loans. It's very tough for SMEs to still crack the loan segment, and which is why, as a promoter, you end up diluting more equity. Trust me, that's been my experience. It's enormous difficulty to get a loan as a startup, and I'm saying it as a promoter of a 100-company organization.
So, 2 points there, Arun. One is Axis Bank, for example. Today, if you look at businesses between with turnovers of 5 crores to 1,000 crores, that is 20% of our book. and is growing at 30% a year. It's a business, like I mentioned to you, we are very, very excited about. We've also cracked the code on being able to lend to startups. But please remember that we have a fiduciary responsibility. We are managing depositors' money, and therefore we will be conservative as far as the risk that we take on the asset side. But we do believe that the SME sector is something that is very exciting, and it is a large part of our balance sheet.
I just want to add two things. One, if you look at the private sector banks, the top few, bulk of the growth in the last 2 years has come from the small to SME, right? The small part of the SME, the mid part of the SME, and the mid-market companies, not the large corporate growth, right? So banks actually are focused on that segment. Most of them are around their branches or in a different area or in their sectors, etc. So that growth has been healthy. I think you have to distinguish between startups and SMEs. I think as far as SMEs are concerned, there is a huge focus and credit is being dispensed to SMEs right from COVID, whether it was ECLGS or now post-facto when they all survived. Startups are a different breed. See, startups need risk capital in the initial period. Banks don't provide that. That's where equity comes in. As they get into mid-tier and, in their cycle into what you call the mature cycle, they come into the banking sector to leverage. In fact, they don't leverage themselves because at their early stage, they need risk capital. 1 in 10 startup may survive or 1 in 100. I don't know the statistics, right? And as Rajiv said, we have a fiduciary responsibility to our depositors. Each bank has its philosophy. So you should distinguish between startups and MSME. On MSME, there is a big focus by banks. Startups in the maturity cycle, rightly for them, should be when they should take leverage. They should not take leverage at the angel end.
All right. So we'll close it at that. Thank you so much, Ms. Rajivanandan and Ms. Shanti Kamram, for joining us on this panel. Thank you so much for listening. We'll take a leave.
Big round of applause, gentlemen, ladies and gentlemen.